Question 23 asks us to calculate the carrying value of property, plant and equipment as it would be presented in the consolidated statement of financial position for the ER group at the 31st of December 20X2. So if we go and have a look at this one, then the group structure is that ER acquired 80% of the equity share capital of MR back on the 1st of January 2000X10. So we are looking at a parent and subsidiary relationship. Tells us some details about that purchase and then carries on to say that at the date of acquisition, the fair value of the net assets was the same as the book value, with the exception of some property, plant and equipment, where the fair value was $400,000 higher than book value. So as part of our consolidation process, we would have dealt with a fair value adjustment at the date of acquisition of $400,000. However, that increase in the value of our property, plant and equipment would need to be spread over the estimated useful life, which here we've been given 10 years. Then goes on to finish off by telling us the carrying value of PPE in each of the individual financial statements of both the parent and the subsidiary. So as part of the consolidation process, we're going to take the value of PPE for both parent and subsidiary and add them together. We then need to reflect the increase in the fair value of those assets of the subsidiary of $400,000. But having made that fair value adjustment, we need to then take out a depreciation charge up to this point. And in this question, what we needed to be careful of was our dates. The purchase takes place back in 20XO. We're actually looking at a calculation at 20X2. So the $400,000 fair value adjustment would be spread over the 10-year useful life. But here we're looking at 3 years worth of that charge, the year to December X0, 1 and 2. So that the final adjustment is to reduce the PPE by 120 to leave us with an answer here of $8,180.